Hello and welcome to a recap of our lecture on Goodwill, looking at Goodwill in a bit more detail. So we're going to add in a second way to calculate Goodwill should you be asked for it in the exam, and we're going to look at impairment of Goodwill here. But starting with our gross Goodwill, remember this was our calculation up to this date, and this is called full or gross Goodwill. And the thing to note about this, or to recognise, is that it allocates goodwill to the non-controlling interest. Just like all of the other assets for the statement of financial position, the non-controlling interest gets a share. So a share of all the other assets and a share of goodwill. Now, just a note on this, because sometimes you won't be given the fair value of the NCI in the question. You may have to calculate it yourself. So let's just learn how to do that. So this was an important bit on how to calculate the fair value of the NCI at acquisition. So what we needed to do was take the NCI percentage and multiply by the total number of subsidiary shares. So that would be, say, 20% times the 1,000 subsidiary shares. So that would give you 200. Basically, that, remember, gives you the number of shares the NCI owns. We then multiplied that by the market value of those shares. So the market value of the subsidiary shares. And that gives you the fair value of the NCI at acquisition. Now that's very simple and straightforward until you get it in an exam question and you've got the market value of the parent shares, the market value of the subsidiary shares, and maybe the nominal value of those also, and you get confused as to which one to use. So remember, for the fair value of the NCI, you use the market value of the subsidiaries' shares. So we did an example of that in illustration 10 to make sure we could calculate it. Now, that's the goodwill we've used up to date. I want to also note that IFRS 3 allows us, if we choose, to calculate proportionate goodwill. Now, this is the way it was done before gross or full goodwill was introduced. So this was the goodwill working, cost of investment of the parent, less the parent's percentage of the net assets at acquisition from working to. And that gives you the goodwill. Now do note that that's goodwill attributable to the parent. There wouldn't be any goodwill attributable to the NCI in this instance. So if you see the words proportionate or partial, then this is the working you need to do. And you do need to learn this because the examiner could ask for either. Now, 80% of the time it will be gross or full goodwill, but just occasionally it could be proportionate. So you need to learn this working also. What's the difference? Well, this proportionate goodwill, remember, doesn't give goodwill to the NCI. And that's a little bit inconsistent because all of the other assets are included in the NCI. They get a share of the non-current assets, the inventory, cash, all the rest of it, but they don't get a share of goodwill using this method. So it's inconsistent, and that's why they brought in the new gross or full goodwill. However, you can be asked either. Either is acceptable. The NCI working would be this then, because we wouldn't have a fair value of the NCI to use in our other working, so you also need to learn this working. The NCI percentage times the subsidiaries' net assets at the year end from our working 2. So we did some detail on that in illustration 11. Make sure you can do that calculation in illustration 11 because it's important just in case the examiner would ask it. So moving on then to impairment. Whether it's gross goodwill or proportionate goodwill, remember it could be impaired. But what does that mean? Well, it means that the carrying value of goodwill exceeds the recoverable amount. So that means it's overstated. So that would lead to an impairment loss. We'd need to write down the value of goodwill. and there's an annual impairment review to see if this is the case. So what if we see this? If we do an impairment review of goodwill and we see that there's an impairment, well, it depends whether we've used gross goodwill or proportionate goodwill. Looking at gross goodwill first, and this is the one that will be used 80 to 90% of the time. So we need to split the impairment for gross goodwill, because remember I said that the NCI gets a share of the goodwill in gross goodwill. So we split it between the parent and the NCI, and we do that in their profit share proportion, the same percentages that we work out in our working one. So how do we do it? Well, we reduce the goodwill by the total amount of the impairment in working 3. So it is going to reduce the value of the goodwill. Then we also reduce the value of the NCI in working 4. So we reduce it by their share of the impairment. And then we reduce accumulated profit in working 5 by the parent's share. So effectively we credit goodwill with the total and we debit working 4 and working 5 with the share that they require. So we looked at illustration 12. There was 3 parts to this, including a full statement of financial position to do. Again, it covers this in detail, so make sure you can do all of those illustrations. Lastly, we mentioned proportionate goodwill impairment and how to deal with that. Well, it was much simpler because there's no goodwill to the NCI in this instance, so we just allocate the impairment to the parent. So we allocate it to the parent and the proportionate goodwill, debit working 5, credit goodwill with the total amount. No need to split it if we have proportionate goodwill that is impaired. So no impact on the NCI in that instance. So just make sure you can do that. We looked at it in illustration 13. Go back to that illustration if you're not sure and have a go at it again. Once again, this is an important session. You need to learn the proportionate goodwill workings just in case they came up, and also if there's an impairment of goodwill, be able to deal with that also.